Welcome to Your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Hey, today we're going to discuss the 3 phases of finance in a deteriorating market. And I really want to start with the premise in the beginning of this very first segment of how we got here, where we are in our journey as the Financial Enhancement Group, my journey, 35 years of being in this industry, and your journey and your financial walk, if you will, through the courses of time and the ways that you need to look at money a little bit differently. Now, I've often told you that I think greed and fear are 2 of the things that interrupt most people's lives in terms of their financial futures. But I will tell you that there are 2 other words that I think have really created a detrimental problem for people as I look at retirement and I look at success and failure in the financial world. And those really are like and trust. So let's talk about what I mean, because they're really dangerous thoughts. There are people that we naturally like. Those are the ones that tell jokes we appreciate, have similar hobbies, similar interests. They're just people you enjoy being around. And when you like being around somebody, let's face it, it's more fun, right? I will always recommend, anytime possible, you work with somebody that you like. But then you get into that trust factor. And what I want you to understand is something that I recently, in the last couple years, came across to redefine the word trust. See, I've seen trust interfere with people's financial future, and I've seen it interfere with the operations of businesses long enough that I really kind of went on a search to say, okay, tell me about the difference in trust, because there has to be different levels of trust. Turns out somebody else had already done the work, and there is a very dramatic difference. One is what we call character trust, and that's the one that I'm used to. It's the one that you're probably used to. It's, do you count on this person for doing and saying what they're going to say, not lying, being respectful, the character trust of what you would expect a family member or a good friend or somebody you can rely on. That's character trust, and I think most of us reside in that ballpark. I know when I hired people to work at the Financial Enhancement Group, when I look at people in my life, I want to like them, and I also look for that character trust. Is this somebody that I can rely on? Competency trust, however, is critical. Now, I think at the end of the day, we all know, I love my doc, but it doesn't mean I would let that doc do surgery on my brain. They're not neurologists. They're, I would not necessarily let somebody that well, you can use all of the different illustrations that you want. We all understand what competency trust is. It's just harder to gauge. If you give character trust to somebody, how do you know they truly have or are worthy of competency trust? And so we end up defaulting, in my opinion, as a mechanism toward the character trust as opposed to the competency trust. So I'm going to look at this and walk you through things that I've seen for a few years in this industry, and then some changes that we went through at the Financial Enhancement Group as we learned to understand the concept, even if we didn't know the name competency trust, changes that we had to make in our journey to be able to better serve the people that we take care of. And again, remember the intent of this show. We are fiduciaries. And if you want to do this on your own, God bless. I want to give you the best that I can possibly give to help make your financial journey successful. If you're looking for a fiduciary, though, that's our business. And it is our hope that you call. But this is not a tease. I'm going to try to give you the thoughts that I have, things that I have seen. So when you get into that like and trust, there's nobody, I would imagine, that you're going to trust more than yourself. I know it's true for me, right? When I look in the mirror, I trust me. I know that I won't steal money. I know that I won't do this thing wrong or that thing wrong, or that I likely will cheat on a diet, right? I trust me. And, one would hope that we like ourselves. I guess that's not always the case, but you would hope. But like and trust get into trouble. And this is one of the predicaments that families get into when they name successor trustees inside of their trust. They tend to name their kids because they count on the kids liking them and trusting them. They know that the kids are going to get the money at the end of the day so that they inevitably would not intentionally harm themselves. And that's where they put character trust in terms of, or in over precedence of competency trust. And so there are very few, I would say probably 1 in 10, instead of naming their kids as the successor trustees, they name a bank or a trust department as the successor trustee. So they've overlooked the like and the character trust and put it all in terms of competency trust, somebody that knows how to professionally manage money. Now, one of the solutions we have at the Financial Enhancement Group is a combination of the two. Clearly, character trust matters. You need somebody who knows you, likes you, wants to care for you, and you also need somebody that knows how to manage money. So our solution inside of our inside of the FEG Trust Services division is actually to be able to bring those two sides together. But one is an illustration of putting character trust over competency trust, is putting kids in charge of your trust. The second is the stockbroker next door or the one in your church. That the guy that you know is just a genuine of heart. Lord knows I've interviewed these people. I know them. They're great people. They have huge hearts. I would trust them with anything I have other than managing your money. There is a difference between character trust and competency trust. I don't know how you measure that, quite frankly. Talking about an industry license to be able to do that job, in my opinion, is not enough. We have a proficiency exam that Aaron Reum, our Director of Financial Planning, gives to all of our advisory team. They have to score a certain level to be able to get on it. It's something that I took from my class at Purdue that I generated there that said, okay, these are the things that I really want you to know about and to understand in terms of what's going on inside of the financial world. So there is a proficiency exam. I don't know what you use, but somehow or another, in my opinion, you've got to have something to be able to measure competency, and it's not just an industry standard. It's not just that they work at a big firm. It's what show me the where's the beef, right? Show me the proof in terms of the pudding. When I look at Financial Enhancement Group over the last 25 years, this is our 25th year anniversary. There have been 4 different major changes that we have made as we have learned the difference between character and competency and what happens in this world. The first one is when we started back in 1997, we had outside money managers. Yes, I oversaw a portfolio, but the majority of the money was held outside other money managers, and we counted on their competency level to be able to take care of you. The question that became very, very quickly was really the character trust that was involved. They didn't know me. They didn't know you. And some of the decisions that they made that hit us in the tech wreck were appalling. Just absolutely wrong. And so we took over the internal money management. Adam Harder is a CFA. He's one of our partners. He's our chief investment officer. Andrew Thrasher is a chartered market technician, one of the graduates from Purdue in the program that I taught there, has been with us for over 10 years. Those two, along with Zach, end up running the portfolios for the most part and taking care of it. We needed to do it internally. Now, once we moved into the world of, well, we take care of tax, we care about tax. As a certified financial planner, I understand tax, or so I thought. And then I got involved with Huth Thompson up in Lafayette, Indiana, and I spent over 10 years as a partner working with Huth Thompson, developing the Financial Enhancement Group inside of their office. And I learned the things that I knew and the things that I didn't know. And there were clearly a lot of things that I was taught as a CFP that didn't necessarily become true in the practical world, if you will. And so we had that combination of those two things working. But that internal money management allowed us to provide much better tax planning advice. And always remember that there's a difference between tax planning and tax preparation. Tax preparation is after the fact. It's what happens in April of the following year. Tax planning typically has to occur before December 31st. When I taught at Purdue, they gave us a textbook for me to teach out of. I taught the senior level course in financial planning, and they gave us this book, 240 pages, $240 a page, $1 a page. I thought it was a little excessive. Anyhow, I didn't like it, and I petitioned Purdue and the CFP board to create my own curriculum. I was allowed to do it, and we trademarked it because I'm an entrepreneur at heart, right? So the family focus process was we knew we needed a direction to take you that covered the entire financial journey. So it started with your financial vision. Everybody wants to make more money. Everybody wants to pay less taxes. Nobody wants to go through probate. But how do you put all of that together inside of a financial journey? And that's where we created the family focus process and we trademarked it. It starts with your financial vision. So if you're doing this on your own, make sure you record your financial vision where it's just a paragraph or 2 sentences that says, here's where I am, here's where I want to get to. This is what we're trying to get to. And I would try to leave numbers or quantitative measurements out of it. Secondly, how you deal with the 5 critical elements, right? Your life after work. How are you going to handle that? The annual tax planning, the investment playbook, dealing with the market volatility. The third is dealing with the life happens. It's the good and bad and ugly of life that are irregular events. And then last but not least is the legacy plan. And you've got to have a way to be able to address each of those. And I would ask yourself this question, or I would ask your spouse if they're not the ones managing the money. Dear, if something happened to me, and I was unable to be here to do this, how are you going to address these areas? Make sure that not all is lost just because you are no longer present, right? And then last but not least, and this is my final end of, if you will, of where we are at the Financial Enhancement Group, for me, is helping people deal with the legacy plan. After dealing with families for 35 years, 25 years at the Financial Enhancement Group, we've watched people have that mental and physical natural decay that takes place. How do you complete the financial journey? And I don't think most people are ready for that. That's what we're working on. So I would give us a call at 800-928-4001. Go to yourlifeafterwork.com. If you want to do this on your own, God bless. But if you're looking for a fiduciary, that's our business. Get signed up for a Next Steps meeting at yourlifeafterwork.com. Character trust is not easy to find or establish. Who do you like? Who do you trust? Who do you count on? Who do you rely on? How do you know? It's just that feeling that most of us have inside of us. Competency trust is easier to measure if you know what it is you're doing. At the Financial Enhancement Group, we use a Proficiency Exam for our financial advisors. We run them through the CFP program to become certified financial planners. We go through an educational process in the planning team every other week where everybody comes together. That's our process. What is your process to stay abreast? Give us a call at 800-928-4001 or go to yourlifeafterwork.com and get signed up for a Next Steps meeting. We look forward to seeing you soon. Well, good morning and welcome back to Your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Today, we're dealing with the 3 phases of finance in a deteriorating market. And we just got done addressing what we call character trust. Those are the people that we naturally like, we feel compelled to believe in, we want to believe in, and we tend to lift them up higher and higher as we believe in them more and more, just assuming that they will not falter at any stage. And then we have competency trust. Competency trust obviously being that part of the understanding of what's going on, of whether it's planning or whether it's medicine or whether it's cooking, whatever it is, keeping up to date and knowing the best possible solutions. What we know for sure, and what I've learned over the last 35 years of being in this industry, is that money works very, very differently at very, very different times. And you're at 3 different building blocks, and so some people prefer this picture, if you will, if you're watching us on YouTube. If not, you can always go to Your Retirement Playbook and find us there. Some people prefer this. I prefer the airplane. I think money looks more like that. So we start in an accumulation phase, and inside of accumulation, what you're really trying to focus on is 2 things. 2 things. Are you saving the right percentage of your money? It's not the amount here, ladies and gentlemen. It's the percentage. So if you're talking to your grandkids or your kids, or you happen to be a youngster listening to the show, it's the percentage that you're saving. Don't get caught up in what the amount is. And then secondly is, are you building tax diversification along the way? We're going to talk about what that is here in a second. Eventually, you will reach the form or the altitude of preservation. Preservation is the only time average return matters. We'll talk about that in the beginning or in the middle segment. But you've got to be there at the beginning and at the end of the period of time for an average return to matter. But that's the only time average return really does matter. Finally, you'll go into our forte, distribution. That's why it's called Your Life After Work. That's our website. Our focus at FEG for 25 years has been on the complexity of distribution. That's why we're so tax focused. You put it in, great job. How do you get it out? So Grant Thompson is one of our associate advisors of the Financial Enhancement Group. He's a youngster, just got married. And I asked him the questions, Grant, inside of accumulation, what would you ask somebody as they were preparing to begin to accumulate money? And these are 4 things that he gave us, and then I'll address a little bit about them more. He said, 1, does your employer have plans such as a 401k? And are you at least putting it in up to the match? So 401k obviously is a company-sponsored plan. You can't do it on your own unless you have your own business. Then you can. But a 401k is for the profit sector. 403b are for teachers and for nurses. And you have the ability to put them in. Typically, there is a match inside of the 401k if you are contributing. Now, some plans actually put money in for you, whether you're contributing or not. But most of them require you to put in a match. It's very typical to see something like 50 cents on the dollar up to 3 or 6% of your income. So if you're making $50,000 a year and you're saving 6% a year, that's $3,000, right? Then the employer is going to match 50 cents on that. That's another $1,500 that they're going to put in the plan for you. That is great. And as Grant so aptly put it in this, are you at least putting in up to the match? That is free money. All free money is good money. Now remember, inside of that company plan, you may have 2 options. One may be a Roth option. One is a tax-deferred option. All money that your employer has to put in has to be tax-deferred. So if they're putting in a match, or if they're whatever they're contributing, has to be tax-deferred. You, on the other hand, if they have an option, gives you the choice of picking whether or not you want to have that money be taxable today, right? So you're paying the taxes on it today, but then you don't have to pay the taxes on it in the future, or whether you want to defer the taxes and get a deduction today and then have to pay the taxes later on. And I will tell you, people that I've dealt with for many, many years still get confused over this. They'll walk in, just happened with one of my closest friends a couple months ago. He said, Joe, I don't understand. We're never going to make more money than we make right now. They're both my age, 55 and 50. We're never going to make more money than we make right now. Why in the world would we be putting money inside of the Roth option? We believe that the tax rate is going to go down, or our income, rather, is going to go down. And I looked at him and said, ladies and gentlemen, friends of the court, you're exactly right. Your income is going to decline. But because you accumulated so well, because the performance of the portfolio has done well over an extended period of time, the market has done well. Because of that, the amount of money that you're going to distribute, whether you spend it or not, is immaterial. The amount of money that you're going to take out of the plan is going to cause you to be in a tax rate, in our opinion, equal to or greater than where you currently are. That's why you're using the Roth option. Remember, when you use that Roth option, it's simply giving you choices. You're making a choice today to be taxed today, but you're also making a choice in the future about when you want to pull the money out. What the tax implication is in the future doesn't matter to you because it's tax-free. You've already paid the taxes that are on it. Right? So that gets us to Grant's question number 3. Are you properly diversifying your tax situation during accumulation? Remember, I told you had 2 goals during accumulation. One was saving the right percentage of your income. The second one was that tax diversification. So ideally, when you go to retire, or when you go to what I call separate from the workforce, because we just don't find most people retired, ideally, in a perfect world, we have 1/3, 1/3, and I realize if you're watching this on YouTube that the drawing's not perfectly equal. I apologize. But at 1/3, 1/3, 1/3, 1/3 of the money is tax deferred. That's money that your employer put in, money that you put in when you didn't have a Roth plan as an option, or you used a tax deferred IRA. 1/3 of it is tax free. That's your Roth option, whether that be in your 401k, 403b, or whether you build it in a Roth IRA. And 1/3 is after tax. Now, why do I do this? Because I want to have choices. Ladies and gentlemen, regardless of how much you prepare for today, there are going to be surprises, good and bad, that hit you along the way through your financial journey. It's just part of the deal. They will come. You want to be the best prepared to deal with surprises, good or bad, as you possibly can. And the best way to do that is tax diversification. If one of you knows for sure what the IRS is going to do, please let me know. Just send me an email and say, hey, Joe, I have an inside track. I know for sure this is what's going to happen. I have people tell me all the time, there's no way the rates aren't going to go up. There's no way that the rates can't go down. You know, we have this mixed belief. And it doesn't even matter what my opinion is. What I want to do is make sure that you are prepared to be able to deal with the consequence of the IRS making decisions in the future that dramatically impact your retirement. See, we spend so much time focusing on what's our average rate of return while failing to look at what's going on in terms of the tax diversification. And I will tell you, if you're young and you're in the accumulation mode, and that's the best way to think about that is when what you're contributing this year is a large percentage of what you've already accumulated, you are very much still in the accumulation phase. When what I'm putting in this year is a sizable percentage of what I already have, you are very much in the accumulation phase. And your focus is not worried about the return. Your focus is make sure that you're building this tax diversification. And understand, as you're younger, while you're younger, you have the option to use the Roth IRA or the Roth 401k, whereas when you're older, you may not qualify. If your income level is higher, you may not qualify to use a Roth IRA. And so don't worry about this 1/3 now. That's the end of the journey. That's the objective when you separate from the workforce. But now get as much of that money as you can in the tax-free side. And this is the one that I see people miss. It's this side over here. Some people used to call it an emergency fund. Well, emergency funds are critical. They're important to have. It doesn't mean they have to be left in cash. It just means it has to be money that's accessible. And remember, in a Roth IRA, your contribution is always accessible. There is no 10% penalty. The contribution, not any conversions and not any growth, but the contribution is always accessible. So you can use that for the emergency fund money if you have to. Start with that tax-free side, get it as loaded as possible, save the right percentage of your income. Don't worry about the amount as much. And then the fourth question that Grant put down is, while the market down, are you continuing to buy? And the answer is, I sure hope so. If you go Google it or you look anywhere, you're going to see programs that are about dollar cost averaging, D-average they call it. And the concept of dollar cost averaging is markets tend to work like this over a period of time. There will be down periods and there will be up periods. And in accumulation, if you're buying along the way, right, even though that this may be a high point relative to right now, it's a low point later on. And so you're able to take all of the prices that you paid, maybe 10, 9, 8, 7, 6, maybe 11, maybe 12. You're able to add all those shares together that you bought, and then you come up with a price that is lower than what the current price is. That's how dollar cost averaging is supposed to work. But the key thing is, do not worry about the return today. What you want is the return to be in the later phases of life. Where you really want to focus right now is saving the right percentage of your income and making sure that you're building the tax diversification along the way. It may sound like a long way away when you're 20, 25, even 30 or 35 and you're trying to raise kids. Joe, I'm 25, 30 years away from being able to separate from the workforce. You know, I just want the best tax break I can get today. Who knows what the future holds? Well, 35 years of history tells me what the future holds, and it's not pretty if you don't plan today. Save well and diversify your taxes, ladies and gentlemen. The accumulation phase is made up of two key components. The first one is saving the right percentage, not an amount, of your income. The second one, though, is building that tax diversification. That is easy to do as long as you have a plan and you've got the right advice. Go to yourlifeafterwork.com or call us at 800-928-4001. Get signed up for your Next Steps meeting. In 90 minutes, we'll give you a complimentary time where we sit down, show you things you want to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Again, that's 800-928-4001 or yourlifeafterwork.com. Hey, welcome back to Your Retirement Playbook. I'm your host, Joe Clark. Happy to have you along. We are focused this week on the three phases of finance in a deteriorating market. We have talked about character trust, the liking, the relatability, the happiness with dealing with a certain person. And you really want to like who you're working with. I get that very much. But we're also dealing with the competency portion. And remember, when we talk about a fiduciary, and I don't mean this offensively at all, but the majority, we all have fiduciaries, but the majority of us are our own fiduciary. Over 90% of the state of Indiana, it's 90% nationwide, do not work with registered investment advisors. They work with brokers, people who buy and sell things, or do it on their own, one or the other. In the state of Indiana, 92% of us do it on our own. So you are likely your own fiduciary. So you've got character trust in yourself. I don't know many people who don't trust themselves, right? But it's that competency trust. How do you know that you know? How does that fit in? The double curse of knowledge is probably the greatest gift I got at Purdue that became very, very aware to me. I don't know what I don't know, but I also don't know what you don't know. And having 7 years, 14 semesters to start over, to learn that just because I'd learned it once didn't mean the next class got it, helped me a tremendous amount. But just understanding that them not knowing and me not knowing what they didn't know really helped us build a stronger financial planning department at the Financial Enhancement Group. And for that, I will always be thankful to Purdue University. So I asked 3 of our associate advisors questions about the 3 phases of finance in a deteriorating market. And the 3 phases of finance are accumulation, preservation, and distribution. 3 very, very, very different periods of time. People, in my opinion and my experience, tend to look at their investment statements the same, regardless of which phase of finance they're in. How much do I have? Second question is, how am I doing? Right? And when people say that, from an investment side, they tend to mean, how am I doing relative to the market, which is not usually a good sampling of what they should be looking at, or how am I doing compared to somebody else my age and my income level, which again is immaterial. You are not them. Every financial decision that you make requires a decision, just what I said. And you know, if you've watched this show for a long time, I love the Cheesecake Factory menu analogy. It is full of 250 options. Everybody loves choices. We just hate making decisions, right? And that's really what it comes down to. With every dollar that you have that comes in, you've got to make a hard decision as to whether or not to spend that today and enjoy it today, right? Or whether you're going to put it away and save it for the future, where you want the biggest impact that you can possibly get, but you're making a decision to delay gratification. A guy named Zig Ziglar years ago said everybody pays a price. Everybody pays a price. You either pay the price of discipline today, or in his Texas accent, the price of regret later on. Love Zig Ziglar. He was a great guy. Passed away just a few years ago. But the concept is very, very simple. When you look at that Cheesecake Factory menu, you're making a choice in terms of looking at all of those things that are on there. And you may have narrowed it down to 3 or 4 or 15 or even 1, but then the waiter walks over and now you have to make the actual decision. And that's really, really, really what happens inside of the finance world. So in accumulation, remember, your 2 focuses were tax planning, building tax diversification along the way, and the second one was making sure that you're saving the right percentage of your money. The sooner you start, the younger you are, because of compound interest, the less you need to save percentage-wise. Then you move into preservation, and this is where life gets to be really, really ugly. I've done this for a long time, so I'm going to mention a name, Peter Lynch, that some of you have probably never even heard of. But Peter Lynch was a legend at Fidelity, and and people don't understand how average returns work. But Fidelity used to average present in the late 90s that this Fidelity fund had averaged over 10% a year. It was actually a lot higher than that, but I'm just going to use that number just to give you an illustration. Peter Lynch apparently was a very ethical guy, wrote a book, Lynch on Lynch, and talked about some of the mishappenings with these statements. The only way you're ever going to get an average return, ladies and gentlemen, is to be there beginning, middle, and end, right? So when a market does this, right, through 2008, through a pandemic, through whatever we're having right now, you have to be willing to hold the course if you're going to talk about an average return. Now, please don't take that as me telling you that you should hold the course. That's not what I'm saying at all, right? But what I'm saying is if you're going to talk about or rely upon average rates of return, then you've got to understand where we are in each of these periods of time, and you've got to be willing to hold out through the beginning, through the middle, and through the end if you're going to be able to get that return or be able to utilize it. So in Lynch's in the Fidelity ads, Peter Lynch averaged, and it was a lot more than 10%, double that plus, over 25-year period of time, and people are going, "That's incredible!" And so here's the point. Lynch writes a book that essentially said over half his investors lost money. Now, that's kind of interesting. How can you have an average return that was well over that number? I don't even want to put it up there because it's scary. Well over that number. How can you have an average return that did that and over half your investors lose money? Well, it's because you have to be there beginning, middle, and end in order to have the average return. And what happened invariably is when he had these significant returns, people would put more money in here. And even though you talk about an average return and you know you have to be there beginning, middle, and end, people would pull money out here. So when you pull money out when it's down, it doesn't matter what the average return is. It doesn't get you there. It doesn't have the capacity to be able to grow. And people end up dying in that preservation stage. This, by the way, is Wall Street's favorite, is the preservation stage. It doesn't matter what you add this year, they'll take the new contributions, but it's building off that baby that you've already got, and they don't have to worry about distributions. You, however, have to focus on that average return. So Michael Matchett is one of our advisors down in the Fisher's office. And Michael, I asked the question because they're in that middle stage. His wife's a hospital administrator. What are the questions that you're getting in terms of the preservation stage? And the first one is, how soon can I retire? It's like, Mike, I hope you're not trying to tell me anything here. How soon can I retire? It's a great question. When can I separate from the workforce? And obviously, life expectancy comes into a big play in that. The longer you work, by definition, even if you live to be 150, the longer you work, the shorter your working life expectancy will be. Just because you have less years, just because you worked a year longer. We don't know how long we're going to be here. So I think you have to adopt a different attitude about life. I've always said, and I will always say, that retirement or separation from work, or what I like to call your life after work, is not a function of age. It is purely a function of money. And that money is broken into a couple different areas. It's broken into your budget, and it's broken into your desire at the end to what to leave behind, if you will. So from a budget side, how much money does it take to maintain your standard of living? How much do you have to be able to get to that next stage, if you will, of what it takes to manage that standard of living? We've talked about fixed and social expenses a lot. If you don't know what I'm talking about there, go to yourlifeafterwork.com or Your Retirement Playbook. You can find information on the retirement budget. The second question is, when should you take Social Security? Remember, Social Security, this is one of those silo questions that people like to ask. we look at Social Security as a singular decision. It's kind of like separating from work. When can I do it? A singular decision. How much should I put in my 401k? A singular decision. You need to look at it as an entire farm operation, not a silo, and think about all this together. And it's very, very tempting to take Social Security early, but I really recommend you understand the tax implications of doing that. That's where you deal with an advisor that understands the combination of how to do some of these strategies, how to bring that whole farm operation together so that you can make the right decision. This is a one-time opportunity. Do not get it wrong, right? I mean, Social Security is huge in the balance. 3, what and should I are we doing about inflation? That is a critical thing, right? I've often said on the show that if people could take money and hide it in a mattress and get the same average return that we got in the marketplace, much of the money would stay inside of the mattress. But we all know that that's not the case. Inflation is real. It's not transitory. It is real. And we're going to have this pressure for an extended period of time, in my opinion, especially on services, maybe not so much on goods. But inflation is one of those things that cost more and more money. The older we get, the more we tend to spend on services, the less we tend to spend on goods. I think inflation is really pitted against us as people that are aging in the workforce and heading into that retirement period of time. We've got to make sure that our money has the ability to grow and not just at interest rates or inflation rates. So you'll hear the word real and nominal. Nominal is a return that you earned. Real is what you get less the inflation rate. So if you earned 3 but inflation is 5, you had a negative 2%. Your purchasing power is declining every year. That is not a good trend, and your trend can be your friend. In this case, it would be your enemy. Do I need to look longer? Is my plan falling apart? There's an interesting commercial that's on the Golf Channel right now, and watching some of the tournaments where the guy said, hey, I thought I was going to have to work a few more years. And she says, no, it's only about 6 more months. I think that's jumping the gun, folks. In 2008 and 2009, I watched people change their standard of living that really, really didn't have to. I tend to look at it as a 3-year focus. So if you run diversification properly in terms of your portfolio, if you pay attention to your form of a risk barometer that we have at the Financial Enhancement Group, and you make decisions correctly, not erratically and not fear or greed based, I don't think you need to make major changes yet. You need to be on attention, but not major changes yet. Do not forget the impact of inflation, and don't get Social Security wrong. Do call us, 800-928-4001. The illusion of the average return is exciting. How much do I get in this perfect world where I was there in the beginning and the middle and the end? The problem is it's not just elusive. You have to sit through all of those ups and downs in the market. It is an illusion because, quite frankly, on average, very few people can get it done. Rarely does somebody sit there with a static portfolio through the 08-09 crisis, through the pandemic, through what's going on inside of the marketplace in 2022. It's just not natural. Should you? Possibly. Should you make changes? Probably. Should you be able to hold to your guns? Yes. Should you look at average return? Probably not. That is not the right answer unless, of course, you're in preservation. That's what this was about. We're getting ready to head into distribution next. Give us a call at the Financial Enhancement Group at 800-928-4001 or go to yourlifeafterwork.com. Well, good morning and welcome back to Your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Still hard for me not to say consider this program. We did that for so many years. But this really is about your retirement playbook. It really is about your financial journey and understanding where you are and where you're headed. And I think that is just an absolute critical part of understanding what's going on in distribution. When I started in the industry, back 2 weeks before the crash in 1987, I didn't understand distribution. I had no concept that people wouldn't want to pull money out of accounts to be able to take care of their retirement. But there were a couple things that existed in 1987 that aren't true today. Roth IRAs didn't exist at all. Regular IRAs and 401ks didn't start until essentially 1980 in terms of the 401k market, if you will. IRAs were a little bit sooner. When we look at that, though, the amount of money that people were able to contribute relative to the amount of money that they had stored in other places was very, very minimal. The average person walking down the road didn't need somebody like me as a registered investment advisor or a fiduciary to help them. The money was going inside of a 401k. They were in the accumulation phase. It was a much smaller amount than what they had in other areas, certainly relative to their pension, if you were a General Motors or Caterpillar or Eli Lilly person. But things changed over a period of years. I didn't realize people wouldn't take money out to appreciate their standard of living. Two, I didn't understand the tax planning implication until I got into the mid-90s, in 94 or 95, so over 30 years ago, close to 30 years ago. I didn't understand the implication of what the tax pain would be like when people made the distributions and how Social Security would impact that tax bracket. See, we were taught academically along the way that as you age, you will make less money, therefore your tax rate would go down. We were taught that when people retired, they only needed 70% of their income to be able to, at retirement time. And folks, that is just all wrong. You need 100% of whatever your standard of living is. And two, for those of you who are listening to the show, my guess is what you've saved and accumulated is probably better than most people's, and you've probably been more attentive to it. It's probably done better. And the reality is you're at a higher tax bracket in many cases, or at least equal to what you worked at, which means that tax diversification is critical. So we talked about the three phases of finance and what to think about in a deteriorating market for this week's show. So remember, in the accumulation phase, that's when you're starting out. Your objective is twofold: saving the right percentage of your income. The younger you are, the lower the percentage you need to save, and then you just need to stick with it for your entire career. Secondly is building tax diversification. Ideally, 1/3 tax deferred, 1/3 tax free, and 1/3 after tax that you can get to at any and all times. Think about things like weddings. Eventually, you get into the preservation stage, and we talked about this a minute ago, where the only time that preservation actually, or average return, matters is in preservation. But you have to be committed to being there at the beginning, the middle, and the end of the process. And what my experience says, what market history shows, is that very few people make it through all of the ups and downs of the market. You have people who bail out at the bottom continuously, and you have people who put money in the market at the top continuously. And then there's our lucky few that reside throughout the middle that are just consistently and continuously using it correctly. Most of us fall deemed to emotional praise, whether that be the fear of the market continuing to fall down or the greed of the market continuing to go up, and how long until we're multi-billionaires. Preservation is the only period of time where average return matters. Distribution is my baby. It's the one that we built the Financial Enhancement Group to take care of. It's about the whole thing. There's no reason to win the football game at halftime. You want to have the high score going into the locker room? Sure. You want to feel good about your numbers and your receptions and your takeaways and all that? Sure. But at the end of the day, when the scoreboard is over, when there's no time left on the timer, you want to have the winning score then. And in your financial journey, that means that you got distribution right, that you were taking out the amount of money that you needed to maintain your standard of living. And if you lived another day, you still had enough money to do that. In other words, some of us want to spend everything that we have, but we don't know when God's going to call us home. And some of us want to intentionally leave money behind for our friends, our family, our charities. Right? So it's whatever your objective is your objective. It's fine. It's right. If you look in the mirror and you're comfortable with it, it's right for you. But you want to be able to hit that target. We don't know the last day we're going to be here, so there will always be some that is left. But in that distribution phase, the two sciences here are, one, the tax rate of the average dollar that you pull out of your retirement accounts, or that you pay on your tax return, I should say, because that includes Social Security. And secondly, the volatility between distribution points. And this is where it becomes very, very important. When we talked about a market going up and down, and let's just make it a little more graphic so it's a little more obvious. Markets tend to do this, right? So if you look at my career, I've been blessed to have lived through more volatility than anybody in the Great Depression. I know that sounds obnoxious and an exaggeration. It's not. 2 weeks before the crash in 87, I started. 91. We'll just go straight to the tech wreck. We don't even have to worry about 98. Tech wreck, 2002. 2008 and 9 in the Great Recession, the pandemic. It's been a crazy career that I've had. Markets tend to do this. They go way up, they come down, they go up. So you've got a series of higher highs. So if you're able to stick in the game over an extended period of time, it all works out. You have a series of lower lows. So if you're able to stay in the game, it all works out. And in preservation, as long as you were there beginning, middle, and end, it still worked out. You still did better, even though you may have retired at a down period in the market. It still worked out for you. Now, the problem is distribution is entirely different. It is its own little beast. See, in distribution, you're never there beginning, middle, and end. Because in distribution, you're taking money out along the way. And so when you take out money down here at a depressed market, it never gets the opportunity to grow back up. That dollar is already taken out and pulled out. Now, I can't show you. This was a chart that came from Smith Barney that we used in the 2002, 2003 era. Smith Barney obviously is part of Morgan Stanley now, doesn't even exist anymore as a firm. But when you looked at the chart, what it showed was contributions from 1985, I believe it was, until 2000. And the S&P 500 had an average return. Let's just say it was 10%. I don't remember the numbers. But the illustration was critical. An average return of 10%. And at the end of the period of time, somebody took out a little bit of money. How much money did they have left at the end of the period of time? They were taking out about a 5% withdrawal rate. How much money did they have at the end of the time? And you know, smart people with math would go, okay, well, if the average was 10 and they took out half, they still had a 5% compound rate, No, the person actually ran out of money in like the 17th year or the 15th year, somewhere in there. Because average return only matters if you're there beginning, middle, and end. In distribution, when you're constantly pulling money out, it never gets the chance to grow. And now we live in one of these markets today where we have a huge problem. We had a run-up, a bull market from 2012 all the way through essentially even the pandemic into 2022. And people were taking out a much larger percentage, in my opinion, and our Director of Financial Planning's opinion, taking out a much larger percentage than they should have because the market has allowed that to occur for so long. And now the new people that are retiring are having novice. Again, we talked about competency trust earlier in the show. You're having people who've not been around for an extended period of time, 10 years or more, that are saying, hey, yes, you can take out 5% a year. Look at what the market has averaged. Averages don't matter in distribution. And people are getting punished and retirements are getting ruined by people that are using these wonderful little reports, putting in wrong assumptions, wrong numbers. Everybody wants to tell the best story they can tell. But the reality is, at the end of the day, it is our job to make sure you survive the financial journey. That means I need you to understand that distribution is different. It is different, and be very, very careful when you're dealing with people who don't have a track record inside of that distribution phase. So 4 questions that came from Deborah Falkenberg, one of our associate advisors. She's also a certified financial planner. One is, how is inflation affecting my distributions? Well, by definition, the purchasing power is going down if things are becoming more expensive. So we either need to raise the amount of money you're distributing, or you've got less money to be able to purchase things. So far, in our experience, what we're seeing from our people who are retired, that's not been a big impact so far. It's a frustration, but not a big impact. Should I take my accounts to cash was number 2, and the absolute answer to that is never. You can get out, but remember, if you get out, you've got to do 2 things right. You've got to get back in, and by definition, when you get back in, it's got to feel worse than when you got out. It just doesn't happen, ladies and gentlemen. People who go to cash never get back in. Purchasing power just flat out destroys their life savings over a period of time. Do I need to go back to work was question number 3, and the answer to that, in my opinion, is this is relatively new. I would say no, if you've had a proper diversified allocation strategy, both to investments and to income. That's what we provide people with at the Financial Enhancement Group, to keep you set up for that so that you're in good shape and ready to roll. We look at life in 3-year increments. 2008, 2009, I told people they didn't need to go back to work. You didn't need to change your distribution. Some people did it anyhow, very few, but some did it anyhow. What we ended up seeing at the end of the 2011, 2012 period is there was no reason to go back and do that. Life worked out just as it was supposed to do. Am I going to outlive my money? Well, obviously that depends on how long you live and how much you spend. And everything is a trade-off. It's that Cheesecake Factory menu. It's that you've got the decisions you've got to make. You've got all the choices in the world, but you have to make decisions at the end of the day about which one you're going to go to. You can spend more today, you'll have less later. You can save more today, you'll have more later, in theory. But that's really, really the challenge. You've got to figure it out. That's one of those things we would love to help you with. It's where you really have to focus on standard of living and understanding the numbers, understanding that budget. The fixed budget needs to last forever. In my opinion, the discretionary budget, you can manage a little more. Welcome back to Your Retirement Playbook. I am your host, Joe Clark. Happy to have you along. Well, the theme of this show was very, very simple. It was the 3 phases of finance in a deteriorating market. See, the question we get asked a lot is, Joe, does your theory of the 3 phases of finance change over market conditions? And the answer is no, not a chance, not any way, shape, or form. The article this week that will go in concert with this show is what is the one thing that accumulation, preservation, and distribution have in common? And the answer is the tax man. The IRS is there along the way, just waiting for you to make a decision so that they can tell you what the impact is. Now remember, in accumulation, your objective, right, is saving the right percentage of income and building tax diversification. In preservation, it's the only time average return matters. And here's where tax planning comes into play. It is so easy to put money in the tax deferred area because we feel like we're making more money in that phase of our life than we're going to make later on. But we forget about the impact of required minimum distributions, the addition of Social Security, and future income sources. And then in distribution, your 2 objectives are what's the tax rate on the average dollar that I pulled out. Notice tax, tax, tax. And then third is volatility. In each of those 3 distributions, you've got to be prepared for what is going on. Accumulation, preservation, distribution, they're all different, but they are all subject to the tax man. So how do we build tax diversification? Well, that's where we would invite you to come in to see us as fiduciaries. Remember, as a fiduciary, our job is to treat your money as if it were our money and we were in a similar situation. We don't sell products. We're going to provide guidance and advice. We offer a next steps meeting. And in that next steps, we're going to give you 90 minutes of our time complimentary. And in that 90 minutes, if you bring in your information, we will give you things that you're going to want to consider right now, things you're going to want to consider in the future. And if FEG and you choose to partner together, we'll tell you what we'll do for you and we'll put it into writing. Now, you have to bring in your stuff. We provide the time. Seems to be a pretty fair deal. Go to yourlifeafterwork.com or call us at 800-928-4001. Get signed up for your next steps meeting, and when you're ready, we'll be here, and I look forward to meeting you then.